I'm back. So I had to rush on that last video because I only have 15 minutes to make a video. Otherwise, the video will not record properly. And I was at 14 minutes and 59 seconds. So I'm going to go back a little bit and talk about franchises. Okay? So you've heard of different type of franchise, whether it's Subway, Marriott, McDonald's, etc. The owner of the franchise is known as the franchisor. If you want to acquire a part ownership of the establishment, you become the franchisee. So you probably heard about people buying into Subway, buying into Taco Bell, buying into McDonald's. They're going to sign a contract with the franchisor. The actual license would be for a limited life. So it could be, depending on the term, for 10 years, 15 years, 20 years, but it does have a limited life. There's an actual fee that's paid to the franchisor by the franchisee. That franchise fee will be expensed over the actual life of the franchise, and that will be known as amortization expense. If by chance the franchise has an indefinite life, meaning the contract is not going to expire, then that cost is not going to be amortized. So if we spend, say, $100,000 on a franchise for a 10-year limited life, then you expense $10,000 every year. But if we spend $100,000 on a franchise and there is a limited life, meaning it's indefinite, then that $100,000 just stays as an asset on your balance sheet under the intangible assets section. Okay? Goodwill. Goodwill is an intangible asset that is only recognized through the acquisition of a business. Make sure you understand that. Goodwill is an intangible asset that can only be recognized through the acquisition of a business. Goodwill is the excess of the purchase price over the fair market value of the identifiable net assets acquired. Perhaps you're saying, what does that mean? Let's say that you decide to buy a clothing store that is already in business. The clothing store will look at all of the assets of the clothing store. It could be the equipment inside, the furniture fixtures, the inventory, etc. And maybe everything inside the store has a fair market value in the amount of $200,000. Okay? But the store owner is selling the business for $225,000. Perhaps you're saying, well, why would we pay $25,000 more than the asset's fair market value? I'm glad you asked that question. Because they're what we call goodwill attributes. The store may be in a desirable location. It may already have good customer relationships. It may have skilled employees. They have high quality products. And so we're saying that the previous store owners have worked hard over the years to build up a good reputation, to make sure they have quality employees, selling quality products. So when the previous store owner sells their business, they want compensation for what's known as those intangible attributes. So goodwill can only be recognized through the purchase of an actual business. It is the excess of the purchase price over the fair market value of the assets we're going to acquire. Okay? Here we have the Coca-Cola Company. First, their PP&E section, they have land, building and improvements, machine equipment, and other. It shows the original cost of those assets less any accumulated depreciation to get their book value. For their intangible asset, and these numbers are in millions, they have their trademarks, they have their goodwills, and they have bottlers franchise rights with indefinite lives, so those are not going to be amortized, and they have other intangible assets. Look at the trademarks, and these numbers are in millions, meaning that the trademark has a value of roughly $6.5 billion. So the Coca-Cola name and logo is worth $6.5 billion. But hey, I like Pepsi. Now let's look at a few analysis and we'll be done with chapter 9. Return on assets. So when I acquire these long-term tangible assets, even if I acquire these intangible assets, we're saying what is return on my investment. To do that, we look at the net income that was earned divided by the average total assets. To get your average total assets, you take total assets at the beginning of the year plus total assets at the end of the year and divide those by 2. And that would give your average total assets. So for JetBlue Airlines, in 2013, return on asset was 2.3%, which improved quite a bit in 2014 to 6.8%. So we see they're improving from one year to the next. They're doing actually better than some with airlines in regards to return on assets, and they're doing better than the airline industry as a whole. Next ratio would be the asset turnover ratio, which indicates the efficiency a company is using assets to generate sales. So we're saying how efficiently are we using our equipment, our machinery, in order to generate sales for the actual business. Okay? So to get your net sales, of course, is sales revenue minus sales discount minus any sales return, divide that by the average total assets. So the assets turned over 0.75 times in 2013. It improved to 0.77 times in 2014. So we see that they did improve from one year to the next. However, they're not doing as well as their competitors, being Southwest Airlines, and they're a little under target for the industry as a whole. So when you have the ratio analysis, we compare ourselves to we compare one account period to the next, compare ourselves against our competitors, and also against the industry as a whole. Profit margin revisited, we covered this before. So profit margin times asset turnover gives us our return on asset. Because the net sales, we cancel that out, that leaves you with net income divided by the average total assets. So now we see the relationship between these different ratios. So again, your profit margin times your asset turnover will give you a return on asset ratio. Okay? So here we look at the profit margin for these assets times their asset turnover, and that will give us our return on assets. So we see that Southwest is more effective at generating sales, 0.94, but overall, JetBlue was better at deriving a profit from its actual sales. So which would you rather be more efficient at, generating sales or deriving at the actual profit? You would rather be more efficient at getting a profit than generating the actual sales. So that will conclude our videos for chapter 9. Be sure to review these videos and we will discuss this in greater detail in class next week. Okay? All right.